Hi there, thanks for tuning in. So in a lot of the financial content that I watch or read or consume in general, I find a lot of talk about diversification, how it's very important to not put all your eggs in one basket, to invest into different kinds of companies, of ventures, of real estate, etc., etc. But after those kinds of statements, there's actually very little talk about what being diversified actually means, what it actually does, what kinds of diversification there is, or if it even makes sense for you to be diversified. For some people, you could genuinely make a case for them not being as diversified in their investments no matter what they are. So hopefully my thoughts in this video will help clarify what it really means to be diversified, if diversifying is absolutely necessary, and just how diversified you should be, and in what kinds of areas you should look towards diversifying. And I'll start this by quoting a famous quote by Warren Buffett, which has been mentioned many times and taken out of context many times, which is that diversification is protection against ignorance. Diversification is a protection against ignorance because essentially, if you don't know what you're doing, or if you don't have the time to dedicate to investing in a specific kind of investment, well, diversification is actually protecting you against yourself. If I'm invested into 10 positions and I did really bad research on 1 or 2 positions, well, even if those positions completely fall in value, maybe the other positions I've been invested in won't fall in value and thus will hold the overall value of my investments steady. In that specific example, I'm protecting myself against my own ignorance or lack of due diligence, because at the end of the day, the more investments you have, the more likely it is that one or a couple of them will actually succeed and be profitable. And this applies to many kinds of investing, such as stock market investing, real estate, venture capital, cryptocurrency, whatever you can think of. Essentially, it is mitigating and managing risk, and it is one of the first risk management things you can do in your personal portfolio. But on the flip side of that, diversification actually makes little sense if you know what you're doing. And in the example of Warren Buffett himself, well, he is not actually particularly diversified. He is so experienced that he knows what he's looking for. He does his calculations. He talks to managers of companies, and then if he has high conviction in investments, he'll go all in. He is kind of putting all his eggs in one basket, but those baskets are the best you could ever find. And this is true of many other prominent investors. They don't have all that many positions, or maybe their gains are given to them by 1 or 2 key positions that really rose in value. For example, if we compare the performance of Tesla as of the making of this video versus the S&P 500, well, you can see that this one stock overperformed the S&P 500 by a lot in the last years, and someone who had 100% of their portfolio in this one stock, well, they'd be exposed to a lot more risk, but at the same time, they would make so much more profits and gains out of this because they had all their eggs in one basket and that went right, versus the top 500 companies in the US, well, they gained value, but they didn't gain as much as Tesla. And if you're gonna do something like this, you need to do an incredible amount of research and an incredibly high conviction to only hold a few positions that you really believe in. You need to get to that point where you know what you're doing, or where your research justifies just grabbing a few positions that you think are gonna overperform everything else. So there we can find 2 different kinds of recommendations from the get-go. If you're someone who really wants to be the best of the best, and you wanna put all those hours in, and you have a lot of conviction, a lot of patience, and you are not easily moved by seeing red numbers, well, then you can maybe get away with having a few positions that you really believe in and not being as diversified, because hopefully those positions will overperform other more broad indexes. But if you're someone who doesn't have the time to put all that research in, well, then maybe investing into a broader market that's incredibly diversified is the right decision for you, since you don't want to dedicate all that time to investing, to researching, to keeping up with your investments. Because it's important to remember that investing is a time commitment, and the more investments you have, well, the more you have to keep up with those investments and read their updated numbers, updated letters, etc., etc. So if I own 20 stocks, well, that's 20 reports I have to read every single quarter if I'm keeping up with the numbers of the companies I'm invested in. This is something that people just frankly don't have the time to do sometimes. And if you're in that position, well, sometimes it's better to just invest into a diversified ETF, where you can look up an ETF that has goals that match yours or strategies that you personally like, and then go on from there and put a lot of money into that one position, which is already pretty diversified. And then your research would be more focused into finding that one or a couple of ETFs that you really, really like and that will drive you to invest a lot into them instead of finding all these individual companies that you have to keep up with. But at the same time, well, the more diversified you are, the more your returns will look like the average market returns. And for those who hold few positions or whose few positions have greatly outperformed the general markets, well, it's important to note that some of the best investments have really amazing good years and really awful bad years. That is to say, in the years where the markets in general do good, these investments tend to rise and heavily outperform the general market. But in years where the markets in general do bad, these investments tend to fall way below the market. One of those examples can be Warren Buffett's company, Berkshire Hathaway. The share price has seen its wild swings, but it has overperformed the S&P 500, for example, even though it has fallen further than the S&P 500 did on bad years. So that's something you have to be prepared for if you're not really all that diversified, and you have to be very patient. You have to be able to hold it in when you see those red numbers and hold that temptation to maybe sell off or react emotionally. So let's say you're on the other side though. Let's say you don't have a lot of positions right now in whatever you're investing in and you want to diversify further. Well, there's quite a few kinds of diversification that you can do. And I'm going to take the example of the stock market, but this really applies to basically every kind of investing. If I want to diversify my stock market investments more, well, I can diversify different companies. That is, I can buy a lot of different companies that do different things. I can diversify sectors. That means that the amount that I have invested into a given sector won't cross a certain threshold or percentage in my portfolio. And basically that protects me from the downturn of a certain economic sector. For example, say telecommunications heavily underperforms in a given year. Well, if 15% of my portfolio is in telecommunications, I won't be nearly as affected as if 50% was. You can diversify countries and regions. That is to say, for example, if the UK has a very bad year in terms of the economy, in terms of the earnings that companies have, well, if all the stocks you own are based in the UK, you're not going to have a great time. However, if some of the stocks you own are in the UK, but others are based in the Americas and Africa and Asia, well, you're not going to see as much of a downturn in your portfolio as someone who is purely invested in the UK, and the other world economies that are hopefully doing better will actually cover your portfolio. This can also take the form of investing in companies that are selling their products or services in multiple countries already. That means that they're not purely dependent on the economic performance of a given country. And that leads me to another point, which is that you can diversify into individual companies that have many diversified sources of income. For example, take Microsoft, which has, for example, a cloud sector and a software services sector and a gaming sector, and these are all different sources of income. So if one of these sources of income happens to shrink, well, maybe if the other ones grew, you won't really feel that downturn from that one source of income that Microsoft has shrinking. And the final point applies to every single kind of investing, which is that you can diversify your personal income sources. That is to say, if I'm a person who makes all my money right now from real estate, well, maybe I want to take some of that money and reinvest it into things other than real estate, such as, for example, the stock market, venture capital, cryptocurrency, etc. That means that if one of the kinds of investing that you're doing or getting income from, it has a huge downturn or all of a sudden is no longer there for you, well, you're covered in other kinds of investments. This can actually be really fun if you like a challenge, because you're going to have to figure out how to make money in all these different types of investing, and you're going to have to dwell into a different world. But it can be very fun if you like that process of researching and learning something new. Now, I'm not giving any specific recommendations on you should be diversified in sectors and countries, etc., but it's just for you to ponder whether or not you have to be so diversified. And if you do, what kind of diversifying do you want to do? Or are the companies you're investing in already diversified? It's interesting that people are told to diversify for the sake of it, because I think that advice doesn't actually apply to everyone, or in some cases they're not being told what the different kinds of diversification they can do are, and I think that's also a detractor for them. There has to be more conversation what it means to diversify, and I hope I brought up some good points in the process. That's all I have for today, but before I go, if you're interested in investing in the stock market, well, I highly recommend you use Webull as your broker. If you sign up with them and deposit at least $100, you can get 2 free stocks completely free, and it's a fantastic broker that'll get you started in your investing journey. There's a link for you to sign up for them down in the description. With that said, I thank you so much for watching. I want to hear your thoughts. What are your thoughts on diversification overall? How diversified are you? Are you seeking to diversify more? What kinds of diversifying are you doing? So thanks again so much for tuning in. And if you want to see more like this, remember to subscribe and let me know what you want to see. And with that said, have a fantastic day.